Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Manish Singh, CFA CIO at Crossbridge Capital, joining in. Manish, welcome to the show, and always a pleasure to speak to you.
Thank you.
Manish, my first question coming to you is overall, let's start off with the budget. How would you actually describe the budget, and did it actually match your expectations?
Well, I think that if we start by giving a number, I would say that on a scale of 1 to 10, for me, it measures up to 8. So there were a lot of good things that came out. Clearly, the focus on investment in infrastructure is very good. The budget lagged any gimmicks for the right reason. It did not think about just give tax cuts or just cater to the pander to the middle class, even though it's an election year in some of the states. So I think that is a good sign that it was a grown-up budget. It's away from gimmicks and more focused on what is good for the country for medium to long term. And investments is definitely one thing, and infrastructure when it comes to investment is a big part of that. So I think those things were very, very positive. Where I think the budget fell short was the divestment is not as aggressive. You need more capital to make investments, and one of the easiest and the safest way is to release the locked up capital. The state has no business to own so much of enterprises. It should be transferred gradually but surely to encourage wider participation and better management. And so divestment, I think, maybe they had their plans are to divest more quickly. It's just that I didn't see much of that in this budget. So I think that's one place where the budget was lacking. Apart from that, keeping the budget deficit at 6.5, i.e. not giving in to demands of many people, what we call the Washington consensus that you should keep your deficit lower. I think keeping the deficit at the current level is fine, so long as those capitals are being used for investment purposes. So there were many good things. So it's almost like India is not doing the cheap politics, which used to happen in the past, where the government, insecure about the future, would indulge in short-term measures and not think about medium to long-term. And that comes from stability, political stability that we have. And it'll just make the government more bolder in taking all the right steps, and even making the opposition come and realize that they cannot indulge in silly politics. They have to do what is good for the nation. So on those factors, I would say it scores very highly.
Right. So is it right to say that, yes, this is a growth-oriented budget, this is a capex-heavy budget, and the government is looking at long-term measures and not like short-term fixes?
That's true. And you saw the Prime Minister yesterday in Lok Sabha underline this and make a point for everyone to tell them that what this is about. So you had the Finance Minister say that, and then you had the Prime Minister repeat yesterday, saying that the focus clearly is on medium to long-term way of planning the nation towards more self-independence, self-reliance, do the big spending from the government side. And also remember that if the private sector is concerned about a lot of things, and of course there are always a lot of things to get concerned about, it's the government spending that keeps them also on the right footing. If you see that the government is planning to spend 100 billion or thereabouts, then the private sector feels, well, I mean, they can go ahead and they can do their own planning and spending, because the government is going to keep pushing the GDP growth higher, because we need that. And that is part of the productivity growth that a growing nation like India needs. So it's not just enough that India is the fastest growing nation out of large economies. I mean, one has to keep that pace and not be just bogged down by, okay, if everyone else is growing at 5%, we are growing at 6%, we are the fastest. That doesn't give you anything. You should really grow at what is required to meet the job requirements and the needs of a growing economy like India. You see China grew at like double-digit figures. Some years they grew at 12, 13%. So just growing at 7 or 8%, and that is the fastest among all the large nations, should not itself be a satisfactory criteria. the growth should be pushed higher. You should be able to get productivity higher, because that will eventually mean bigger GDP and bigger economy. The sooner you get there, the better. I think India is doing very well in that sense, but we could do better. And that will come from, the lead will be from the government side, but the private sector will take the government's lead and then follow up.
Absolutely. The contribution of private sector as well to growth is very crucial in terms of where the investments are concerned. Moving from there on, how are you seeing the markets really react to the budget? Because clearly, we've crossed 18,000 levels already. Right now, we are still off that high that we'd seen in the recent past. Do you think the valuation, what the outlook of the economy is, and the way markets have moved, there is a slight mismatch and there is going to be an adjustment that would happen?
I think it's bound to happen, because there are various other factors. What you look from budget and government measures is a set of confirmation that we are on the track, or the economy is on the track. Anything by way of the movement in the equity market, there are several other factors which is going to play. And this is where the US Federal Reserve and the central bank policies come into play. So the guardrails are there, that the fiscal spending is going to happen and the government is committed to that. And then you have other macro factors which plays out. And there, as you know, that the opinion is divided still, whether Fed is going to raise rates 3 times or 5 times or 6 times. So I think, and what will happen to the strength of the dollar, and what that means for emerging market currencies. And that does become an impact. So I would say that even though the budget has been a good budget and focuses on what is going to be the future, but that is all about what happens over the next 2 to 5 years. What happens in next week, next month, or a month, that there are several other factors on play. And there, the larger macro factors become important. You are seeing the indices go nowhere for most part in the US and Europe, other places as well. You've seen Bank of England increase rates in the UK, ECB completely getting wrong-footed and now talking about inflation is becoming a concern. And you saw the big move in the bond deals in the European market. So that's happening, and the move and the bond yield in the European market was much severe and violent than what you've seen in the equity market. So these factors are going to play on medium-term basis. Looking at budget places India in a good context, but of course, being an emerging market or growing economy, you can't escape what's happening in the larger economy. When we have the US CPI number print this Thursday, the consensus is it should print at 7.3%. The last print was 7%. If it comes at 7.3 or lower, then I would expect that the equity market will feel very positive that the inflation is peaking and central banks will not be in a rush to raise rates. But if it comes at 8 or over, then you will have a panic again in the market that, okay, what is it going to do? Is it going to force Fed to raise rates much aggressively in 50 basis point ticket? Or so those are still factors that is going to have an impact on the market, and which is, you can't guess. I mean, it's very difficult to guess. One, you can take a 3 to 6 month view. On 3 to 6 month view, I think that the inflation is going to peak very soon, and Fed will not be raising rates more than twice or thrice, in my opinion. The market thinks it can raise 6 times, 5 times. I think the market is wrong. Inflation is going to peak, and then, but that does not mean that you will have a runaway new highs for next 6-7 months, because there will be growth concerns about if the rates are going to get increased, and there will be some growth concern. We've had good run so far. To me, it is going to be a year which will be marked by a low return, at least talking on the broad index level in the US, and one will have to adjust to it.
So taking all of these global factors into consideration, how are you expecting Indian markets to actually react? Because clearly, if you go to see, the FIs have continued to remain sellers in terms of the Indian equity market.
Mhm. So again, if I look at the Nifty and Sensex performance in the last interest rate hike cycle, which was from 2016 to 2018, 2019, when Fed raised rates from 0.5 level to 2.5%. During that time, you saw the Sensex perform around 14 or 15% per annum over the 2-year period. But there were at least 4, if not 5, 10% plus corrections. So the way to I see what is likely going to happen, you will have a very similar thing. And as I said, it is dependent on the CPI number, which comes on Thursday. If that comes higher and there's a feeling that that is going to set higher again next month, then you will see some move in the market. You will see some sell-off in the market. Now, as an investor, you always have to bear in mind what happens over the next 3 months and what you think is going to be the likely position or level of index in 2 years' time. My feeling is that it's going to be higher in a year, 2 years' time. So if there is something that happens over next week, 2 week, or a month where we have sell-off linked to not domestic factor, but what is happening in the international market, then that's your opportunity to make some new investments and buy the assets that you like already, which are now cheaper. And that is the way to build your portfolio. I always seek from an investor point of view, not from a trader point of view. And I think you always invest for medium to long term. And when you have concerns about medium term or long term, then basically you stay in cash. I do not have concerns about medium term. I do not think that Fed can reduce its balance sheet by a lot. And they will raise rates because, of course, if you are at 4.5% unemployment, which is almost record low and better than the pre-pandemic or near the pre-pandemic levels, then clearly there's no reason for the rates to be at 0.5 or 0.25%. It should be higher. But if it sets to 1% in, let's say, 2 or 3 hikes from now on, that should not be a cause for panic. And if there are growth concerns, then you will have to look at what the fiscal policies are going to be. But there is no other alternative. Where are you going to put your money? In bond? That's not going to make you a lot of money. And if you're concerned about interest rate increase, the last place you want to be is in the bond market. So I think it doesn't leave you much alternative. You still have to buy growth. You still have to buy good quality stocks which are going to deliver earnings. And that should be the key criteria in my mind of when you make investments.
Right. So overall, in terms of Indian markets as well, what sectors do you think could be growth drivers from here on?
So the consumer sectors may be in a bit of a pickle at this time because it is being driven by many factors that I don't fully know how open up India is at this time in terms of people are going about their work and others. But I would think that anything related to infra spending that should, or anything related to credit expansion. I mean, these two things are going to continue. The credit is going to expand. So anything related to infrastructure, autos, banks, I mean, those things are probably going to do well. The ones related to consumer, I think those will need some time to catch up because you have to have avenues and means for consumers to start spending, for them to feel that they should, and not that there is another variant coming down the line, because these two variants have changed behavior in many ways. People have focused on they need to save, they need to keep money for when things get bad. So I think that security and surety has to come, and that is going to come gradually, and then you will see a pickup in consumer staples or consumer discretionary spending. But then there are things around, well, the government is ready to spend and make infra spending. Any sector related to that is going to be the key beneficiary. And also, if we talk about mobility, where people know that they have to move to get jobs and it is not going to be where they are, and those sectors, and this is where auto comes into play, that has a role to play. I mean, the thing you've seen the government doing is that now they are focusing on intra-city infrastructure. They have done a lot about intercity, but they need to focus on intra-city to drive mobility, to have a subway system or to have other systems. I mean, if you compare to the way we see in London, I mean, people still use their cars. They use the subway system a lot more, but you still tend to have your autos and cars because when you go out of town, then you need those things to go out. And so I don't think people are going to give up on car, or and as one gets prosperous and more middle and upper middle income, you end up having more than one cars for various reasons. So I think those things are not something which will be subject to a massive slowdown. Anything we saw during pandemic, I mean, those things will go away and those spendings are going to come back and they will catch up again. So these are the sectors that I would really focus on. And of course, healthcare, which clearly will be a demand and people will be more conscious about their health benefits. And that overall is very positive for India, because if there's one place that India has lacked is in healthcare. If your average health of the nation increases, it automatically increases your productivity as well and growth with that. So there's plenty to be done, but it's such a growing market with a long growth ahead of it, that you can't talk down any particular sector. It's just a matter of cycle where you are. But otherwise, I think a lot of the sectors, or most of the sectors, are going to grow.
Absolutely. And with this, overall, if you go to see, there are a lot of geopolitical concerns as well. Right now, we've been talking about Russia, Ukraine. There's something going on usually with regards to China as well. How big an impact could that have in terms of markets across?
So I would say that, I do not think Russia is sitting over there to invade Ukraine. I think there's a lot of stories swirling around, and that is just mischief making and news making. If you speak to, and I have spoken to people in Moscow and people in Kiev as well, I don't think anybody wants a war. I mean, not the people, definitely not the people, and the leaders who have been very careful in wording things. You see, even Ukraine to some extent has, in double quotes, accused America that they are fear mongering, where America actually is supporting Ukraine. So they do not want this rhetoric to turn into a war-like scenario. Overnight, you saw the risk ratcheting down again. And that's what President Macron says in his meeting that he had with President Putin. So I just don't see a big, of course, you never say never and things happen by accident. But at the risk of war, I think the narrative has run way ahead of events. In my opinion, I think a risk of a big war is unlikely because it just doesn't benefit either side. And there will be far more pragmatism than we have ever seen in the past. And that just tells you how well interlinked the economies are, that when you are in isolation, the chances of war are much higher. But when you have over-reliance or reliance on each other, where Russia has to sell its energy to Europe and Europe has to get its energy from Russia. So it's not it's a no-win situation where things are concerned. And that's the benefit of globalization or economies working with each other, that you become more dependent on other, and therefore the war is absolutely the last resort. And there are many things that happens before that which can avert it. So I think it will be averted, and which means that it's just a concern, but it is not going to be a real event.
Right. And anything that you have to say with regards to how crude could actually react to all of this? Because everyone's talking of that, yeah, what if United States actually puts out a sanction, on Russia? How do you see that impacting? Because that's one of the factors on a macro level which impacts economies.
So I would say that as far as crude is concerned, there is something else which is more important. There has been a severe lack of investment in the oil and gas sector, and the world seemed to be paying a price. So the oil trading at over 94 or 90 levels where it is now, purely by, if you look at, let's say we are coming out of all this COVID crisis and growth is going to accelerate. All the net zero agenda and climate change and all, it has not helped in the sense that, it hasn't answered the energy question, that how can you replace the fossil fuel so quickly by renewable. And again, we've seen in the UK that, at one point we were around 10-20% of our energy was coming from wind power. But when wind stops blowing, which it happened on few occasions, then you need to fire up your coal and gas. Now, yesterday in the UK, there was a decision made that there will be new investment, at least 6 plants, I believe, in oil and gas sector. So this realization is dawning on everyone that while climate activism is good, and it might sound good and look good because we are all green and doing climate evangelism in many ways, the reality is that you risk the economy, especially for a large developed economy like UK and the US and other places. So if you take that into account, there has been serial lack of investment and deterrence because big companies have not been allowed to make investments, or they have been forced to look at green and clean agenda and therefore cut down some of their earlier projects. Then if that picks up again, as with community, as you know, it takes a few years for supply to come online, but the narrative can build up. I do not see that oil can sustain a high level. I just don't see that. The energy supply from the US and their own energy independence is the crucial factor. They are a big consumer, but they also export natural gas and other things that they have done over the last few years. There is supply. I mean, what really is the problem is that if people decide that we don't need to produce enough, and that can happen when groups can work together. As soon as this scare goes away, because remember with the Russia-Ukraine thing, there's one more thing going on, is that if Russia decides to not supply energy to Europe, or if US, as President Biden was saying yesterday, decides to stop Nord Stream 2, which I think will be a declaration of war in many ways because Russia will not take it very kindly, then these things could shoot higher. But again, with energy, it will be a short-term thing. You saw last year or the year before where oil was trading at a negative level, like how quickly it has all bounced back. So in 2019, we saw oil going down to negative. 2020, we saw oil going down to negative level at one point because of the way futures market work. And then suddenly the energy sector had the best rally over last year, and they are the best sector this year as well. But there's as much you can run. I mean, if you come from minus $37, which was at the time, then yes, you can come way back. But I think most of the rally is done. The oil price may not fall immediately, but I think we are about to hit very peak levels where it could stay. But for it to rally much higher than that, there has to be something more specific happening on the production side, and there is enough supply of energy in there, and that is one reason why oil sustained at a 60 and 50 level for some time, and I don't think that has changed.
Absolutely. So a lot of things we need to watch out for from here as well. Thank you, Manish, so much for joining us on the show. It's always a pleasure to speak to you and get insights from you. Thank you so much. Stay safe and speak to you soon again.
Thank you for having me. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.